This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Right, you're happy with all those ratios? Have you had a look through them? You may even have attempted the examples already. I don't think there's anything that is too challenging within them. So it's nice to know that there's some easy computation aspects within the exam. So first example that we're going to look at is focusing on the liquidity ratios, which means looking at your current ratio and quick ratio. Current ratio, yep, current assets over current liabilities. Quick ratio, current assets less inventory, isn't it? So removing the inventory to work out your quick ratio, giving you a more accurate reflection, if you like, of your liquidity. So what you've just got some extracts from Ariel's statement of financial position. You've got your assets at the top, your liabilities there at the bottom. So your total current assets, if you add them up, 50, 70 and 10, is that 130,000. 88 and 7 is that 95,000. So when you're going through that and working out your current ratio, it's the 130,000 divided by 95,000 is that at 1.37 to 1. Okay. What does it say? It says that we have more current assets than current liabilities. That's it. We don't know whether it's gone up. We don't know whether it's gone down. We don't even know what the industry is. If it was a heavy manufacturing industry, you might regard that as being a bit low. If you're looking at a supermarket, which tends to be less than 1, you could regard that as being quite high. Okay, so we're just doing the calculations. In terms of your quick ratio, that takes the current assets of 130 and deducts the inventory, is it there, of 50, and again divides it by, is it the 95,000. Again, double check on your calculator, gives me there 0.84 to 1. Okay, so yeah, that there is ever so slightly more liabilities than what you have with regard to more liquid assets. But hopefully that inventory will be quite fast moving. You'll be able to sell it reasonably quickly to compensate for that. Okay, but if the payables and the interest was due on demand, you may struggle to go through and pay things back. But at the end of the day, this is a ratio. We do have cash at bank, so that's a good starting point, isn't it? It's not as if we're overdrawn. If we were overdrawn, I would be a little bit more concerned. Okay. Excellent. So that's the first one, looking at your liquidity ratios. If we go on and then have a look at the second example, which is there all to do with your efficiency ratios, that's looking at inventory days, receivable days and payable days, isn't it? So it wants us to go through that. We're looking at extract from the TB. It's for the financial year. So it's not 6 months, it's not 3 months quarterly, it's a full year. So I want to take my statement of financial position figure at the year end, divide it by a statement of profit or loss, and multiply by 365 days. Okay. Excellent. Again, you can see there that you have these SFP figures. Is it the inventory, receivables and payables? You've got the profit or loss figures above, but do just be careful, because we want to look at credit sales, don't we, with regards to receivables, and we want to look at credit purchases with regards to your payables. Okay, so what we can do, I'll use a separate page of paper here. If we're looking at my inventory days, it takes my year-end inventory of 220 and divides it by the 1,800. So is that 220 divided by the 1,800 multiplied by 365 gives me 44.6 days. So to you and I, 45 days. Again, the question would be specific with regards to rounding. Usually it would be to the nearest day, but I'll leave it there, 44.6. Don't put in number of hours, don't be so ridiculous. You then have is it your receivable days? So that takes your receivables divided by your credit sales. So receivables are 350. The credit sales are 85%, aren't they, of the 2600. So if I take, is it the 350 divided by 85% of 2600 and multiply by 365, does that give me 57.8 days? Okay, excellent. Last but by no means least is going through there, isn't it, and looking at your payable days. Your payable days, take your payables, which we have there at 260, but remember it's dividing it, isn't it, by your credit purchases, of which our total purchases were 1650, our credit are 90% of them. So 260 divided by 90% of 1650 multiplied by 365 gives me 63.9 days. Okay, excellent. If you so wished, if you wanted to work out your working capital cycle, okay, so how long does it go through there and take to get the cash in, or if you like, how long are you without cash within a business, and we'll touch upon this in a moment shortly. If I can find my calculator back there on the floor, 44.6 plus 57.8, that's 63.9, gives me 38.5 days. Okay, we'll explain that in a little bit more detail afterwards. Okay, but that's your working capital cycle, or your cash operating cycle, the number of days that the business is without cash, but I will elaborate on that afterwards. Okay, what you may have to do, instead of working out the number of days and the working capital cycle, you may actually have to go through there and look at the physical amount of working capital that you require within the business. Okay, gone just a little bit too far. There we go, perfect. So the question, instead of asking you to work out the number of days, is asking you to work out the investment in the working capital. So how much in raw dollar terms should you have of working capital in regards to inventory, receivables and payables? Okay, because what you're given is the operating cycle figures there in terms of the number of days, and we know, don't we, that the number of days that you calculate, so what's being given there, is the statement of financial position figure divided by profit or loss multiplied by 365, isn't it? Okay, here what we're looking at is to find out the amount of working capital invested in the statement of financial position. So what we're going to go through and do is we're going to take the number of days, we're going to multiply that by the profit or loss figure, and then we are going to divide by 365 to rearrange that equation, aren't we? Okay, that's what we need to play with. Again, we've got the number of days here, haven't we, in terms of inventory, receivables and payables at the bottom. We've got the revenue, which we will use. We're given gross profit. We could work out your cost of sales, couldn't we? Quite simply by being the difference. 250 less 90 is that, oh, my mind's gone blank, 160. Okay, so cost of sales of there is it as 160,000. Okay, excellent. So let's go through, have a play around with the numbers and see how we get on. So there's our last question. Let's just go through there and work out, we'll go through there and look at inventory, our investment in inventory. Inventory we stock for 68 days. So it's 68 divided by 365, and we multiply by our cost of sales figure, don't we? Which is there, is it as 160. So multiply by 160,000. So 68 divided by 365 times 160,000 gives me there, is it an investment of 29,808 I require in my inventory. Okay, that's the amount of inventory that we have that will replenish every 68 days. If I then go through and look at, is it my receivables? The receivables, is it there as 88 days? So 88 divided by 365 multiplied by my sales. Technically it should be credit sales, but there's no distinction between cash and credit here. So my investment in receivables is 60274. So every 88 days I would expect to receive $60,274. My payables that we have, payable days that you've got are 114. Wow. So 114 divided by the 365 multiplied by, technically it should be credit purchases, but we haven't got a credit purchase figure. It's just there, your cost of sales. So my investment there is 49,973. Okay. What you can do there to work out the total investment in working capital, you add your assets investment and deduct your liabilities. So 29808 plus 60274 less 49973 goes through there and gives you a total net investment in working capital of 40109. Okay. Again, you could be asked a question that just asks you for an individual investment in working capital in terms of inventory, receivables or payables. Well, there's nothing, I suppose, to stop the examiner asking you for all of it combined. Okay, there we go. Just to go through, finish it off, we did say we would touch upon it afterwards and give you a little bit more detail. It's talking about your cash operating cycle or your working capital cycle. The definition there is the length of time between the company's outlay on raw materials and the inflow from the sale of goods. So, i.e., the length of time that you are without cash. Okay. So what you've got there is initially, so today at 0, you make a credit purchase. Okay. And then after so many days, you go through there, don't you, and make that payment. Okay. Then what happens is you've got your inventory, you make the sale, don't we, on inventory after so many days. So let's just say that you made the cash payment on 40 days. The credit sale was there, was it, after 70 days? And then the receivable days was there, shall we say, after 105, okay, from today, okay. So what you've got there essentially is the period of time that between the outlay on the raw materials and the cash receipt. This here essentially is your cash operating cycle, isn't it? So after 40 days we make a payment, so therefore we are without cash, and we don't get that cash in until day 105. So here that would be, is it 65 days? Okay. The 105 less the 40, but you're not likely to have it like that within the exam. What's going to happen within the exam, if I move it down ever so slightly, is that you would have your inventory days, is it equal to 70? Your receivable days are equal to, is it 35, isn't it? The difference from 70 to 105. and then you have your payable days was it as 40, and if you total that up, that should give you 65. So that's the number of days that you are without cash, or from its technical definition, the number of days from when you make the payment for your purchase of goods, so the raw materials, until when you receive the cash from the collection of this credit sale. Okay. Which is what we did in that previous example, wasn't it? We worked out inventory days, receivable days, and payable days, and then we worked out your cash operating cycle, or if you like, your working capital cycle. Okay, excellent. Again, 65 days, that's about 2 and a bit months, isn't it? It depends upon the inventory. Heavy manufacturing businesses will have a very long working capital cycle because they have a big investment in inventory and have lots of credit sales, whereby a supermarket, very small inventory days, very small receivable days, and probably quite high payable days. There's nothing to say there that for a supermarket that you could have a negative working capital cycle, which doesn't mean to say that that's a bad thing from the supermarket's perspective. It's possibly not fair on the suppliers, but what it means there is that the supermarket is using the suppliers as a short form period of finance. Okay, a nice cheap method of finance, which is just a little bit unfair and brings about maybe some ethical issues that are beyond the scope of the syllabus at this point in time. Okay, but just be aware that a negative cash operating cycle isn't necessarily a bad thing, but you need to be a large business to be able to have the power over your suppliers to implement that negative cash operating cycle. Okay, so hopefully those questions there that we worked through, the numbers weren't too much of a challenge. It's actually a really good area of the syllabus, I think, to get stuck into the numbers. The discussion aspect, I feel, will come more within the case study. But for now, don't worry about the case study. Practice the objective test questions in whatever revision kit that you have from your tuition providers, and then see how you get on. If you get stuck, then you know where we are.